Welcome to the Deep Dive. We take complex information, find the key insights, and basically give you the shortcut to being properly informed. Today we're jumping into IDBI Bank's Q1 FY26 results. We've got the press release, the financials, analyst questions, the whole lot. That's our source material, our mission. Simple, go past the headlines, unpack these numbers, and give you a clear, concise view of IDBI's performance and where they might be heading. The big question we're kind of tackling is this impressive profit growth really sustainable, or is there maybe something else going on underneath?
Exactly. The aim is to pull all this info together, connect the dots, and explain not just what the numbers are, but really why they matter for the bank. It's about giving you the context so you can form your own view.
Okay, let's get into it then. The big picture first. Looking at the headlines for IDBI Bank's Q1 results, what immediately jumps out? Well, there's a pretty impressive 17% year-on-year jump in net profit. It hit 2,007 crore this quarter, up from about 1,719 crore last year. And operating profit also looks strong, up 13% year-on-year to off 2,354 crore. Looks good on the surface.
Right. And there was, certainly eye-catching figures. What's interesting is how they set the stage for looking deeper. When you see profit growth like that, you immediately ask, okay, what's actually driving it? And it's worth noting their overall total business grew, too, by 8% year-on-year, reaching over 5 lakh crore. So the bank's overall size is expanding alongside profits.
Okay, but here's where it gets, well, really interesting for me. Despite that strong profit number, let's look at net interest income NII and net interest margin NIM. The NII actually dipped slightly. It was 3,166 crore this quarter, down from 3,233 crore last year. And maybe more importantly, the NIM key for lending profitability fell to 3.68% from 4.18% last year. So profits are up, but the core income from lending seems squeezed. That feels like a bit of a disconnect, doesn't it? How do we square that circle?
It's definitely a key point to look at. You see, a falling NII and NIM when profits rising often means something else is boosting the bottom line, not necessarily the core lending business itself. And if we look at the breakdown, operating expenses did go up to about 2,249 crore from 1,963 crore. Employee costs rose. The cost-to-income ratio was around 48.86%. That's reasonably okay, quite competitive, actually. But the really crucial bit seems to be under provisions and contingencies. There was a net reversal of provisions of about 179 crore this quarter.
A net reversal. So they actually added money back to the profit line from funds set aside for bad loans.
Exactly. Think of provisions like a pot of money for expected loan losses. A reversal means either some expected losses didn't happen or they recovered money they'd previously written off. It's good news in a way, cleaning up old issues, but it's a one-off boost, not income from ongoing business. And it was actually a smaller reversal than the 443 crore boost they got the same way last year, Q1 FY25.
Right, so that helps explain the profit jump despite the weaker NII. Still, the overall profitability ratios look decent. Return on assets, ROA, improved a bit to 2.01%, and return on equity, ROE, was 17.91%. Still strong numbers, but profit is just one part right. For a bank's real health, we need to look at asset quality. And here, IDBI seems to have some genuinely good news. Their non-performing assets NPAs have improved quite a bit. Gross NPAs are down to 2.93% this quarter. That's nearly a full percentage point lower than last year's 3.87%. And net NPAs, even better, down to just 0.21% from 0.23%. Very low.
It really is. That points to a much cleaner loan book. And what backs this up is the provision coverage ratio, the PCR. It stood at a remarkable 99.31%. That means they've set aside funds to cover almost all of those tiny remaining net NPAs. It's very high coverage.
99%. Wow.
Yeah, it signaled a very conservative, prudent approach. They also mentioned holding specific provisions under RBI frameworks, about 191 crore plus another 1,300 crore for restructured loans. And another interesting point is their handling of security receipts, or SRs. These are basically IOUs from bad loans they've sold off. They hold over 40,200 crore worth. Now, about 3,300 crore of these are government guaranteed. RBI rules actually allow banks to reverse some provisions held against these government-backed SRs if their value increases, but IDBI hasn't.
So they could have booked more profit by reversing those provisions, but they chose not to.
Precisely. They're keeping them 100% provided for. It means they're prioritizing balance sheet strength over, let's say, a short-term profit boost. Extremely prudent.
That definitely sounds like a sign of strength. Okay, what about growth in the core business then? Deposits and loans. Total deposits were up 7% year-on-year, reaching nearly 2.97 lakh crore, and net advances their loan book grew 9% year-on-year to about 2.12 lakh crore. So solid growth on both sides.
Yes, the growth numbers themselves look steady, But one thing to watch within deposits is the CWA ratio. That's the share of low-cost current and savings accounts. It stood at 44.65% this quarter.
Okay. Is that good or bad?
Well, it's down from 48.57% last year. A lower cancer ratio generally means the bank might be relying more on more expensive deposits, like fixed deposits. This can put pressure on their cost of funds, which might partly explain that decline we saw earlier.
Ah, okay. Makes sense.
On the lending side, though, their strategy seems clear. The loan mix is 30% corporate and 70% retail.
So a definite focus on retail lending.
Yes, very much so.
All right, let's talk capital. A bank's safety net. How resilient is IDBI? The capital adequacy ratio, CRAR, improved significantly. It's up to 25.39% this quarter. That's a jump of almost 300 basis points from 22.42% last year. Tier 1 capital also looks very strong at 23.71%, up from 20.26%. I mean, a CRAR over 25%, that sounds exceptionally high.
It is. That's not just strong. It's, well, almost fortress-like in banking terms. It means they have a huge cushion against potential losses. Think of it as the bank's own capital buffer. Theirs is massive compared to the loans they hold, indicated by risk-weighted assets of about 1.93 lakh crore. The debt-to-equity ratio also improved, down to more 0.48 from 0.60. Lower is better, meaning less reliance on debt.
So financially, very, very solid footing.
Extremely robust balance sheet, yes. And they also mentioned the proposed dividend of 2.1 per share for last year is already factored into these capital numbers. No surprises there.
Okay, moving beyond just the core financials. Anything else interesting pop up in the quarter? Any other developments? Well, they highlighted a few awards. The Bhamasha Award in Rajasthan for CSR in education, another for a digital initiative, OSIN Gem Sahe 2.0 at Finoviti 2025, and also Best Mobile Banking Service from Synix India, so recognition for digital efforts. Plus, an OU with a cancer center in Thiruvananthapuram. So CSR and digital seem to be focus areas.
Right, these show the bank is active in those spaces, although it's interesting, they specifically noted in their disclosures that their dedicated digital banking units, or DBUs, aren't actually operational yet.
Oh, so potential still to be realized there, perhaps.
Seems like it. Also worth noting, their auditors did a limited review of these results and gave an unmodified report, basically a clean bill of health. The results we're discussing are consolidated, meaning they include subsidiaries like their investment banking arm, IDBI Capital Markets, and their tech arm, IDBI Intech. They also include associates like NSDL, though they use the latest available results for those, which might not be Q1 FY26 numbers.
Got it.
And just a small detail, they sold off their stake in a company called PIBDIC for about 19 crore. Seems like tidying up non-core investments.
Okay, so pulling it all together then, what's the key takeaway for you, our listener? We've seen IDBI Bank report strong headline profit growth, yes, but boosted partly by those provision reversals. At the same time, fantastic improvement in asset quality. NPAs are way down, coverage is incredibly high, and their capital position, rock solid. But there are pressures. Net interest margin is down, the seeds-to-areas ratio slipped a bit, suggesting some challenges in the core business or rising funding costs. So it's really a mixed picture, isn't it? A bank with very strong foundations, very prudent, but maybe facing some headwinds on core income growth.
Absolutely. Which leads to, I think, a really interesting question to leave you with. Given this picture, the super strong capital, the cleaned up loan book, that very conservative approach, even with the government SRs, but also the declining NEM and CASA and the fact their digital banking units aren't live yet, what does this combination really tell us about their strategy for sustainable growth going forward? Especially in India's really competitive banking space, they've built this fortress, no doubt. But how are they planning to power the growth engine from here, relying less on things like provision reversals and more on core, repeatable business? That seems like the key question now.